Good afternoon, everybody. Tom, can you hear me okay?
Yes, I can.
Alrighty, here we go. Good afternoon again, and as you can see on the screen, we will be with you shortly starting now. If you are experiencing any audio issues, please use the call-in number provided at the time of your registration. This is just due to increasing use of this webinar platform. It may take a few minutes for the influx of attendees to adjust in the GoToWebinar platform. Here are all the faces of our lovely speakers. We will have a guest speaker this week to be introduced in a few slides later. And just some housekeeping items before we get started and get into the information today. You can customize what you're seeing on the screen today by going to the GoToWebinar screen viewer. This is where you can adjust where the video is and how much of the PowerPoint you see. And all attendees will stay muted during this time together this afternoon. So please submit your questions through the GoToWebinar questions pane, not the chat box, as we do not monitor that. And to help our panelists better manage questions more efficiently, please drop them into the buckets listed there: workforce, technology, regulatory, cash flow, and human resources. This just helps our panelists sort through. And the slide deck is available for download in the handout section of the GoToWebinar panel today. And again, if you're experiencing audio issues, please use the dial-in option that coordinates with your registration rather than the computer audio, or as we learned last week, to toggle back and forth between the computer audio and the dial-in number to hear if there are any audio issues throughout this presentation. And just a small disclaimer here, all information presented today is based on what we know on May 19th, 2020, as of 2 o'clock in the afternoon. And for the 10th or 11th time now, I'm going to say this situation remains fluid. Just some next steps for you. Our next town hall will be Tuesday, May 26th, same time, same place. You will receive a reminder email and a calendar invite for this next week, and to visit our COVID-19 section of the website for any additional information and insight regarding this matter. And you can also reach out to us via our contact page on our website if you need any further assistance or if you have any questions that were not answered today. And our agenda today, we're going to go through our typical introduction, and we will have a few COVID-19 updates today relating to regulatory, cash flow in the PPP, and workforce. We will have a short section on the anticipatory organization, and we will have our COVID-19 roundtable for the next 30, 60, 90 days. And this week we will be having Susan Patrick from our team here at Stambaugh Ness address the technology hard trends that we're seeing today. We will have an R&D tax credit information session, and as always, our Q&A portion of the webinar today. So with that, Tom.
Well, thank you, Kaylee, and welcome everyone again. As Kaylee said, another week's gone by, and it was a very significant 7 days in between our last session. We have a really full agenda for you today. As most of you are probably aware, we finally got some guidance on the PPP forgiveness this week in the form of the PPP forgiveness application being released at about 7 p.m. Eastern time on Friday night. I don't know if they just like to mess with our weekends and doing that, but I know it certainly consumed a lot of us trying to get through that. And Chad and Steve are going to do a very, very thorough walkthrough on that with you today. I think probably more guidance yet is needed even beyond that, but it sure puts us in a better spot than maybe we were a week ago. So I know a lot of you will have a lot of interest in that. We are thrilled to have Susan Patrick with us today from our technology group to talk about some considerations that you'll have with your ERP systems as well. So a very full agenda today. I hope you can stay with us for the full 2 hours. We will try to get to as many questions as possible as well. We'll be answering them behind the scenes online for you, so check that question box. We'll get to as many as we can at the end, and the rest we will certainly follow up with after today's event. As Kaylee said, please keep in touch with us throughout the week. Things do change rapidly. We will be posting things, as we always do, to the website, via our social media channels, and any other means that we can to get information out to you as quick as possible. But when in doubt, don't feel feel free at any time to pick up the phone, give us a call, or send us an email. We're happy to help you out with that. Just a reminder of a couple other events coming up this Friday, May 22nd at 2 p.m. We will be doing a session geared towards the architecture and engineering community on some cash flow boosting strategies for you, some tax things you may or may not have thought about. In June, Kristi is going to be doing a session. We haven't picked a date yet, but on completion of the revised Form 941 to take into account all of these changes that we've seen over the last many weeks. Don't forget our user group meetings and all of our other sessions that you can find at the events page on our website. We're adding things all the time on that. One other thing I just want to mention, next week's session, May 26th, we are excited to have with us for that session Valentina Madura. Valentina is the Senior Managing Director at BDO Capital Advisors out of Boston, Massachusetts. Valentina has a long history working with firms in the merger and acquisitions market and looking at how events like what we're going through with COVID-19 can have an impact on companies' valuations and the markets and such that we're all thinking about as our businesses transition and move forward. So I think you will find her remarks to be very, very interesting next week. So please join us then if you can. So with that, I'm going to actually kick off the regulatory piece this week before we go into the updates that I know you're waiting for from Steve and Chad and Kristi. But I just wanted to talk about a couple of things that went on the last week, kind of around the regulatory end and the tax end. Most of what I have to talk about is sort of speculation at this point, but I know you've probably heard about it and may want some clarity on that. And while the big news on Friday obviously was the PPP application being released, there was some other activity that went on Friday, May 15th as well, and that was the form of the HEROES Act. This is the House's next form of stimulus. HEROES stands for Health and Economic Recovery Omnibus Emergency Solutions Act. Somebody had to be creative to come up with that, to get that acronym HEROES, and that's a mouthful to spit out. But it is quite a bill. It's another $3 trillion bill, about 1,800 pages long. Quite honestly, the odds of it passing as is are probably slim to none. I think you've already heard some mention from the Senate as well as the President that the bill is probably dead on arrival when it arrives at the Senate. But I think it's still significant to talk about it a little bit because there are elements of the bill that quite likely will be considered or brought into play as whatever the next round of stimulus is. So I just wanted to run through that kind of quickly just to let you know what's in there and the kind of things we could be seeing as we move forward. A big chunk of the bill, about $1 trillion of the $3 trillion, is earmarked as funding for state and local governments. As we know, they are all hurting badly. I know I use Pennsylvania as an example, but I think Pennsylvania announced in the month of April their revenues were about 50% of what they normally were. And I think that's representative of states all over the U.S. So without help, you can certainly expect their other revenue sources going to be taxes. So it's kind of maybe a little bit of 6 of one, half dozen of another there. There's also about $200 billion designated for hazard pay funding for our emergency workers and other healthcare workers and such. There are some items in here that do address the PPP, and I think some of these have a good chance of coming to us in some form or another. One is it does restore the deductibility of the forgiveness-related expenses. We talked in great detail about that in last week's session and the impact, I think 2 weeks ago as well, of the tax impact, the cost of losing those deductions. There seems to be a pretty general consensus on both sides of the aisle in Congress to put those back in place. Another thing that it does is in regards to PPP is it eliminates the 75% payroll, 25% other cost requirement. I know Chad's talked about that at length, and we'll hit on that, I think, a little bit today. Whether that one will survive or not, I don't know, but that would certainly be helpful in helping us maximize our forgiveness. It has some provisions in there on student loan forgiveness, a number of other tax provisions that would be enhanced. One of note is the employee retention credit that we've talked about in prior sessions would be enhanced. Right now, it's kind of limited as to who can qualify for that credit, so that would be a plus as well. As I said, I don't think it's going to pass in its current form. In fact, the Senate probably is not even going to consider it till the first or second week in June, when they can reconvene after the Memorial Day holiday. But it is something we're certainly going to keep our eye upon, because we think it could lead to some other negotiations between both sides of the aisle to come up with what we see next. One of the things I heard in a call yesterday is that the Senate is going to push back on another bill until all the CARES Act funding is mobilized. Some of the significant dollars in the CARES Act have not yet been spent. The airline industry, for one, we've all heard about the dollars that are coming their way. That has not been funded yet. The Main Street Loan Program that Chad's talked about before, not yet in place, although I think there was a discussion this morning with Treasury Secretary Powell, who said that is getting close to being operational. So that will be over and above the PPP program and another opportunity for funding for some companies. So it could be the start of the next round of compromise. We have heard that one of the things that Senate Majority Leader McConnell is really pushing hard for, and I think this one is important to most of us in the audience, is he would like to provide some kind of a liability safe harbor for employees who reopen and follow the guidelines and yet would still have employees get infected or sick. He's looking for some protection for them so that employers can reopen with a little bit more confidence. So I think that will be an interesting thing to follow as well. Just a couple of other notes on the tax side before I kick it over to Chad. There was some discussion, some further clarification this week for Section 125 plans. Those plans that you all have out there to allow your employees to purchase their health insurance pre-tax, maybe have a flexible spending account for medical or daycare expenses. Typically, once you make your election for the year, that's pretty much set in stone unless you have a change in life event. There is some ability now, if you as the sponsor agree to it, to modify the plan to allow your employees to make some mid-year modifications of those elections. Folks with daycare, I think that's significant. They may put more money away than they're going to need because the daycare was shut down for a number of weeks or months. So that can be a nice little, I think, benefit to your employees to help them out, maybe get a little bit more cash in their pockets. It does take some action by the plan sponsor, so talk to whoever's administering your account if you'd like to do that. It'll also even allow your employees to carry over a little bit more money to the following year if they don't utilize it all. Also, something I read this week and was shared to me by a colleague, which I appreciate, falls around Section 529 plans. A lot of you probably use Section 529 plans to save for higher education for your children or grandchildren. And they've been very successful plans. You put the money away, it grows tax-free as long as you use it for qualified education. There's no tax on those earnings. Well, as we know, with a lot of campuses, or maybe all campuses, being shut down in mid-March and the students going home to complete their semesters online, we're starting to see room and board refunds and other refunds from the spring 2020 semester to folks. And that's great that we're getting that money back. But a caution to throw out, if you utilize Section 529 funds to pay for those expenses, you can't just, in essence, keep or pocket those expenses without some tax ramification. Remember, those dollars do need to be used for qualified educational expenses. So you have 60 days from the receipt of those monies to either restore them back into the plan for future use, or to actually assign them to use for upcoming expenses. So as long as you use them for expenses anytime here throughout calendar year 2020, you'll be okay. You can say, I'm going to apply that refund to the fall 2020 tuition, or even the spring 2021 tuition if you pay that by year end. But one way or the other, you have to have a tracing that those monies were used for qualified education expenses. As I said, maybe the easiest way is to just put that money back into the account, let it earn for you until you need it again. You do, as I said, you have 60 days from the receipt of that money. And actually, if you got the money before May 15, before last week, you have until July 15. You have a little bit more than 60 days to put it back in. Also remember that as a result of the Secure Act, which was passed in late December of last year, you can use 529 plan dollars for student loan payments. So you have some flexibility there, but just be careful on that, because if you do trip up on that, the earnings will not only be taxable to you, but they're also subject to a 10% penalty, just like when you pull monies out of a retirement plan prematurely. So that's kind of an obscure one that hasn't gotten a lot of play, and I thought that was interesting to share, because I'm sure a lot of folks listening today probably do utilize those 529 plans. So that's a wrap on my information today. Now we're going to get into the meat of what you're all here for, and that's this PPP forgiveness discussion with Chad and Steve.
Thanks, Tom. I appreciate it. And like Tom said, the big news this week was the forgiveness application being released and giving us some guidance. As he alluded to, I am hopeful that there will be some additional guidance coming out, because there are quite a few questions that have been answered, yet still some remain, and perhaps some new ones have come up now that we've got a chance to digest the guidance that did come out last Friday. So a couple things I'd like to hit on first is just some of the general updates around the PPP program and a couple other items. So if we can go ahead and move to the next slide. Two FAQ updates from the Treasury this week, and one was, I think, nearly as impactful perhaps for some companies as the forgiveness guidance is the good faith certification, and the need and what that means in terms of am I eligible to take this loan without repercussion. And question 46 came out and said that if you're under $2 million for your loan, you're deemed to have met the need automatically. So there's no requirements to prove your loan, to make your case. Under $2 million, they're saying that based on your size, you've met it based on that characteristic alone. Over $2 million on the loan front is a case-by-case review. If need is found to be lacking, that you can cure that simply by returning the funds without any further enforcement actions. If you remember, they had talked earlier about potentially, criminal and civil suits and penalties against businesses. So now they're saying basically if you've not met the need requirement, in our opinion, you can remedy that by returning it. No further questions. Now that is not if somebody has created a fraudulent employee, has falsified an application. That's not what they're saying you have a get out of jail free card for. This is just your determination of need was different than the Treasury SBA's. So those were big updates as well. 47 kind of piggybacked off 46 and extended the due date to return the funds till yesterday, May 18th. If you thought you did not meet the need criteria or were concerned about it, and having met, that would mean that you would meet that safe harbor requirement around certification, automatically returning those funds. So those are the two FAQ updates. Just a couple inter and final rules. I think these are pretty minor, and I was really glad to see we had the forgiveness application come out, because I was getting concerned that we were talking about things like electric co-ops that are a pretty narrow niche, and we still hadn't seen that guidance. So it's kind of frustrating waiting to see it and seeing some of the items that they are addressing, but it was encouraging that they did get that released. So May 13th, they did issue guidance that if you took a loan before some of the clarifications around things like partnerships and the self-employment income from partners counting is basically equivalent to wages, you could go back and get additional PPP loan funds, provided that the funding was still available. Similarly with seasonal, they've changed some of the guidance, and you may have been eligible for a larger loan if you had applied the most recent guidance as opposed to the original. So they did clarify that you can go back, discuss with your lender the situation, and potentially get additional funding. May 14th inter final rule was the electric co-ops that I kind of mentioned in jest. Certainly not meant to be an insult, but again, the fact that we're specifically identifying one group, one business type that's eligible for the loans, again, that's going to impact a pretty small group of folks. And then just earlier yesterday, they came out with some guidance around the foreign affiliates and the headcounts related to those entities. And essentially, they said that since the guidance was, I think, lacking is maybe the best word, or unclear, before the May 5th FAQ came out, they're basically saying that if you applied under the prior guidance before May 5th, that basically you have a safe harbor. We're not gonna challenge your employee count as it relates to foreign employees. So just a couple, pretty narrow interim final rules in my opinion, not broad-based, but certainly important if they're relevant to you. Just two other general comments I wanted to make. I just saw literally moments ago that the Treasury did update the statistics through May 16th. What they're doing now is it looks like they actually combined the data from the first and second rounds. So to date through May 16th, 513 billion of the funds have been used out of a total of 659 billion. So we're right under the 80% threshold in terms of what's used. So there are still funds available, which is encouraging. So if anybody's on the call and on the fence and didn't take action, and now you've heard about question 46, you've heard there's still funds, I guess the best thing I could say is I'd encourage you to get your application in now, because I can't promise those funds are going to be there much longer, but they are still there. And I will just add to Tom's comment about the Main Street Lending Program. A couple folks asked about that after last week's session. And still, again, no firm start date on that program for companies that either maybe were not eligible for the PPP or looking for a little more. So that program is still kind of on the runway. So the big news is obviously the forgiveness details. And the application came out Friday, and it has a couple sections. And what I have here is a recap of those sections. We're going to walk through each of those in part. And I'm going to cover what I'll call an overview of the guidance. And then Steve Snyder is going to dig into some of the details on probably the two biggest clarifications and what may be the most time-consuming items in the process, are the wage and FTE reduction. So we're going to walk through some examples and some of the considerations around those two items on the back end. But first, we're going to walk through some of the high-level overviews just to make sure that we're all kind of coming at this from the same aspect and angle before we get into those details. So if you want to go ahead and move the slide, we're going to talk about just a couple of things on the application itself. Again, it came out Friday. There's 4 components and some guidance. There's 2 required submissions. The loan forgiveness calculation form. Essentially, that's what you're going to give to the lender, and then that's a summary of the conclusions. Includes what I'll call the census information on the loan, the statistics, the amount, some other data. And then the Schedule A that's going to accompany that calculation form is a required submission that includes some of the supporting documentation and calculations in the numbers that feed into the form. So those 2 are must required submissions. The other component is Schedule A, and Schedule A sort of works the same way and parallel to the loan forgiveness calculation form and Schedule A. The Schedule A worksheet is meant to supplement and help you work through Schedule A itself. That is not a required form. You could use that form if you wish. You could use other documentation from payroll providers to get the information that you need, but it's there to provide a little bit of a roadmap. The last item is the borrower demographic information form, and this is just a little bit about the borrowers and who received the PPP, about some information about those businesses. And a couple other items that are contained in the application itself are the documentation requirements. So what is the SBA saying they're going to want to require you to provide with the forgiveness? I'm sure based on past experience, lenders are going to have their own unique criteria that they may add or modify some of this guidance, but at least we have a framework now for what is in the SBA's eye required. And again, I'll add that the forgiveness appears to once again be capped at the amount of the loan. Some of the original guidance, the forgiveness was only up to the loan amount, and then the interim final rule said that it excluded accrued interest. Well, now based on the wording and the schedule, it appears that it's capped back at the PPP loan amount itself. So I don't know, again, if that's an oversight, if that was an intentional omission, but it appears like we're back at the original, which was the accrued interest perhaps is not going to be forgiven based on the wording in this guidance. So I'm going to go ahead and we're going to move to the next slide and talk about one of the favorable items that were presented in the application, and that is the ordering of the reductions. So we talked over the last few weeks about the water coming out of the faucet, and then the measurements and the reductions that may apply to that maximum forgiveness, and what we thought the ordering was going to be based on the consensus. Well, I think fortunately we were wrong when you looked at the majority, and they put the salary and hourly wage reduction first. And why might that be? Why is that fortunately? Why did I make that comment? Well, this is a straight dollar reduction in the loans. So it comes off the top, and then they're going to apply the percentage reductions, which are the FTE, and then the 25% total forgiveness maximum for the non-payroll costs. So you're going to be taking a percentage of a smaller number, which is advantageous, and that's a small benefit maybe for some, but for other businesses that could be a very large number depending on the details of your application. So that is the new order: the wage reduction first, and then the FTE reduction quotient, which is were you employing the same number of individuals at June 30th as you were earlier in the process, and then a deduct if you're not, and then the non-payroll cost, 25% cap for the total forgiveness. Two items I did want to mention specifically there is, the salary and hourly wage reduction. They did essentially move that to an annualization average analysis, so you're no longer comparing a 12-week to an 8-week cover period. I think we had all hoped that was going to be the case, but it was just a typo in the guidance, and it turns out that they did remedy that with some of the clarifications that Steve's going to cover in more detail. And then also on number 2, there is an optional simplified method for calculating your part-time employees for the FTE calculation. You can elect to count each part-time employee as half of an FTE automatically. That may be beneficial for some employees or some employers and may be detrimental to others. But perhaps most importantly is if you define your full-time measurement as less than 40 hours. So let's just say 37.5 or 35 is how you define full-time employees. The way we're looking at the guidance right now, it specifically says that 40 is a full-time equivalent. So if you have a group of individuals working 30, 35, 37.5 hours, technically they would be a part-timer under this guidance. So you would not want to make that simplified method election because you would only be counting those employees as a half of an FTE. So maybe a little more legwork that comes out of that to calculate, your FTE numbers than if you were able to take advantage of this simplification method. But we really think it's going to benefit you on the forgiveness front to not select that if you're under 40 hours for your FTE individuals. And again, the final guidance does define 40 hours as an FTE as opposed to 30, which I think most of us had thought was going to be the case earlier. Also, one final comment on the FTE calculations, and Steve will hit on this in more detail, is it did provide a couple more exclusions that are beneficial to businesses as well. So if you remember, we talked about if you offer an employee their job back and they decline for concerns of safety or for whatever reason, that as long as you had documentation of that offer of the decline, that you did not have to count that employee as against your FTE reduction. Well, they also added a couple other items here. So if somebody was fired, if somebody left voluntarily, or they moved to part-time voluntarily, you can adjust your FTE calculation for those. Now, if those individuals were replaced, you don't get to, kind of double dip. But, if you had somebody that left and you weren't yet replacing them, you can adjust your FTEs to help limit the reduction in your forgiveness. So those are a couple of the key highlights, and this is a pretty big part of the guidance. And then the next couple of things I'm going to do is I'm just going to pull up the presentation or the application documents themselves, and I'll just hit on one or two quick items on each form. So if you want to go ahead and advance the next slide to the calculation form itself, so you're going to see they drilled all the details down into a nice one-page form. So it looks pretty simple, but as they say, the devil can be in the details, and we're going to talk about some more of those. And they are asking for some information here, which probably not surprisingly, we're kind of questioning and scratching our heads as to why, because it really doesn't seem to be driven into any of the calculations or measurements. So things like the employees at the time of the loan application, at the forgiveness application, we're really not sure where they might go with that because none of the metrics seem to be driving toward those items. We're just not sure if they're going to somehow use that information to, tell the nation how this program helps the, businesses. It's just not clear on what that's being used for. So a couple other things there. They want your payroll schedule, which I think for most businesses is going to be pretty easy to define. What's our normal payroll cycle? And then most importantly there, about halfway down the screen, you're going to see if the borrower received a PPP loan in excess of $2 million, together with your affiliates, check this box. So I think if I can give you one piece of advice that you take from today's session, if you're under $2 million and don't have any affiliates, don't check the box. So the rest of the form really is driven from Schedule A and some of the other supporting documentation. So I really don't have a whole lot else to cover on the form. So if we can go ahead and move to the next slide. I think what you're going to see is a lot of the details happen on Schedule A and then ultimately on the worksheets. So Schedule A is where you walk through the cash compensation, the average FTEs, and then you enter in and walk down through the various metrics to support the forgiveness form itself. And each of those are defined in the application. Steve's going to touch on some of those, and I won't necessarily bore everybody with the details other than a couple of the items we'll hit on later. We'll hit on some of the changes from what you've heard me say before, but they are pretty well defined in the application. But I do want to pause on line 9 for just a minute. And this is an important addition to the guidance, and this relates to owner's compensation. And particularly if you've been paying bonuses to owners and you historically have not this time of year. This is a critical item to listen to. Second most importance to not checking the $2 million box is if you are paying owner employees, self-employed individuals, you cannot pay them more than what they received last year during this time period. So not only do they have the annualized 100,000 cap for the 8-week period, there's also going to be a limiter that we're going to talk a little bit about further in regards to what they were paid in the prior year. So again, if you're not used to paying bonuses this time of year, there may be some considerations to continuing to do that based on this guidance, and we'll hit on that further later. But Schedule A again walks down through some of the details to provide the numbers that are going to get completed on the face of the application itself. So I'm going to go ahead and we're going to move to the next slide. And what we're going to see here is this is the Schedule A worksheet. So this is the document that's going to support Schedule A itself, and this can come from completing this form, or it can come from your payroll processor, payroll system, any kind of equivalent form. This is not going to be required to be submitted, but you're required to retain it and keep it and have it to support the other documents. So we're going to walk down through a couple of the key points on this worksheet, and again, Steve's going to hit on some of the details with an example later on. But I'll start with the first item is cash compensation. You'll see the 100,000 metric again mentioned at the top and under Table 1. That's defined as the same way it's been. So that's cash compensation, bonuses, tips, leave, commissions, items like that, excluding the family's first sick leave time as it has previously defined. So no changes in that $100,000 definition. And then Table 1 is going to get at everybody that's less than $100,000 and ask you to provide some additional information on those individuals. I think it's a very important consideration that the $100,000 is based on all annualized pay periods for all of 2019. So that may require a little bit of legwork to get that information, particularly if you don't pay your bonuses or commissions at regularly scheduled intervals, that you could easily look at those normal pays, I'll call them. But it's vital, I think, to get as many individuals from Table 1 down to Table 2, because those that were over $100,000, you don't have to apply the wage limitation to. So you don't have to make sure that you're paying them at least 75% of their wages. So I think it's worth the time to get as many employees from Table 1 down to Table 2 as possible. If you have any concerns about, not meeting that 75% compensation requirement, that's a way to maximize your forgiveness. You also see on Table 1 that this is where we're going to look at the reduction for the FTE exceptions that I mentioned briefly in regards to employees terminated with cause and the other reasons. So that number is factored in here in Table 1. And then Table 2 again is those over 100,000, and you can see there's less information gathered there because some of these reductions don't apply to that group. And the bottom of the form walks down through some of the safe harbors and other calculations related to the Schedule A. So again, I'm not going to cover all those right now. And then if we could advance to the last deliverable, I'll call it, from the forgiveness application, and this is the demographic information. And it just asks for some information about the business, the owners, that is optional, not required. Are they a veteran, gender, race, ethnicity? Not required, up to you. And the key point there is the bold item at the bottom of the table that says disclosure is voluntary and will have no bearing on the loan forgiveness decision. So I think it's just important to keep that in mind if you want to provide that information or not. It's noted to not have any impact on the outcome. So that's kind of the 4 key deliverables. What we're going to do is we're going to walk down through some of the other key guidance related to that. So if we want to move to the next slide, we're going to talk a little bit about cash compensation. And we talked earlier that that's the $100,000 cap that is defined the same way as it has been for, really since they started clarifying the guidance, wages, bonuses, commissions, tips, etc. But the big difference here is this topic of incurred and paid, incurred or paid, and what does this all mean, and how do I measure these periods? So this is where I think we got the most clarity out of the guidance. So eligible payroll costs are costs that are either paid during the covered period. Covered period starts when the loan is funded, is in an 8-week period, or it's costs incurred during the 8-week period and paid on or before the next regular pay date. So again, if that final payroll, if the actual funding of those checks happens outside of the 8-week period, they've made it that as long as you pay it when you're in ordinary payroll cycle, you don't have to schedule that off-cycle pay to try to maximize your forgiveness. So they've provided some administrative relief here in regards to making it easier to get your payroll counted for the days worked. So that's a very welcome change. I skipped over the comment about the alternate covered period. I'm going to hit on that in just a moment. But I wanted to pause first and just define what they mean by paid or incurred as it relates to payroll costs. Paid is the day the check's distributed. If you're distributing physical checks, to me that would include put in the mail, or placed in the mail, or the day that the borrower originates the ACH to fund the payroll. So that's how paid is defined. Incurred then is the day that the pay is earned. So that is the day that the individual works that they're earning compensation for. Now, what's this alternative covered pay period? And what's this about? This is an optional election, so it's not required, that allows you to use the 8-week period that starts on the first day of the first pay following the PPP loan disbursement date. And again, this should also help eliminate the need to run those off-cycle payrolls. So these 2 items together, we really think are nice administrative simplifications. So what does this mean? Well, if my pay period ended, or let's just say my loan started today, May 19th, and my payroll started for the next week on May 25th, next Monday. I could elect to start my 8-week period on the 25th. And then run it from there. And that way everything lines up nicely. I could just submit the 8 weeks payroll. No need to split the pay periods or anything like that. What's another advantage of this? Well, potentially if you delay it a couple days, maybe your business opens back up. Maybe you're able to get people back on payroll, and you can use a pay roll that has a little higher wages in it. So there's some other potentially nice benefits in the right circumstance, but really we think it's mostly an administrative simplification that's much appreciated. So we can go ahead and skip over to the next slide. One of the other simplifications is they've elected to limit the compensation during the 8-week period basically to 8/52 of 100,000, and depending on how you route or calculate it, it's around 15,385. So no longer do you have to annualize if it's if it's 26 pays, 24, 52. Now you just have one number to keep in mind, 15,385 during the 8-week period. We talked earlier about the owner's compensation a little bit, and here it is on writing. So the owner's compensation is capped at the lesser of the 15,385 or the 8-week equivalent of compensation in 2019. And this may negatively impact the ability to pay bonuses to owners if not paid in the same time period last year. Something to keep in mind, this may not be too significant unless the owner's salary throughout the year is less than $100,000 and they bonus themselves over $100,000 at the end of the year, because the owner's compensation was capped at $100,000 during the application process itself. So we're hoping that doesn't impact folks too negatively. Again, this guidance just came out now here that folks are 5-6 weeks into their covered period potentially. And we're hoping it's the last negative curveball, but really that's one of the few negatives in this guidance that we saw. And I'll even say it's a potential negative depending on how that information worked out for each business. So I think that's really the end of the payroll components. So we're going to flip over now to the next slide and talk about some of the non-cash compensation items. So these are the fringes, not specifically payroll. A key point is the guidance on the retirement benefits was really not explicitly provided here. So it's kind of leaving us a little bit in limbo here. Do we follow the payroll cost guidance related to retirement? Do we follow the guidance on non-payroll costs, which we'll get to momentarily? So it's a little bit gray still on how to calculate those, unfortunately. And that's one of the main reasons why we think there might be some additional guidance forthcoming. Owner fringe benefits is another question. They're not specifically mentioned in Schedule A, that only reference owner's compensation. So some have taken that to say, well, these fringes for owners must not be allowable then. It's not clear to me that they are impermissible, but they're not specifically listed either. So our take is that the retirement, health insurance, state and local taxes, our take is that those are allowable, but they would just show up on lines 6 through 8 of the form, along with the other employees' fringes. So we'll see what that shapes up like, hopefully as additional guidance comes out, but it's just something to be aware of. And then if you want to go ahead and move to the next slide, we're going to talk about some of the other costs here. And this is non-payroll related completely. So this is your rent, your utilities, your interest, and other items of that nature. So again, similar guidance here that the cost must be paid during the cover period or incurred during the cover period and paid on or before the next billing date, even if that happens after the end of the 8-week cover period. So again, this adds another administrative convenience in that you don't have to cut and split your health and other benefits and portions for those that don't align with the 8-week cover period. But it also adds some significant flexibility because it introduces the concept of the cost must be paid during the cover period only. So there's the potential for costs that were incurred before to be paid in the 8-week cover period to help you get to your 25% maximum of these other costs. So we think that's a nice change. And also on the back end, if you incurred the cost for a monthly utility but didn't get billed for it until after the 8-week cover period, you can still include that. So it's nice that they've eliminated some of the games and extra work potentially to get those costs into the 8-week cover period. So what remains unclear, no additional utilities noted and no additional guidance on the existing utilities were in this application. So I've listed there the utilities that were previously noted. Again, no changes there. And then is there a question if you're required to split utility bills on the back end? Again, it's very unlikely that they'll line up exactly with the 8-week cover period. So if I have a bill that came in that covers half of the cover period, or is half in the cover period, half in the not, we're assuming that we'd have to throw out the piece that is not in the cover period. But again, that's opinion at this point. And then some questions around interest. They did make it clear again in the guidance that it's for mortgage or secured loans is how we're interpreting that. But what about line of credits, capital lease interest, and really, some questions there remain. Some talk about capital leases and would that maybe be permissible as rent as opposed to interest. So there's some things that we're getting into more and more finite questions when we're getting into things like that. So a lot of the broader items have been clarified, but a couple of things that are still loose ends, such as this. So if we want to go ahead to the next slide, we're going to talk about, or I'm just going to really just show a couple of the required certifications. And I really want to pause here only because we all recall how much that required certification around need ended up creating a lot of stress and anxiety. So we don't want to do these a disservice and not hit them with required certifications on the back end of this for forgiveness. So basically, you've used funds as intended. You've applied all the application reductions and caps in your calculations of forgiveness. Just that you're aware that unauthorized use may lead to penalties. And a couple other items there regarding the documentation and other information. So I'm not going to read all those and for the sake of time. But I would suggest when you're doing your application, take your time, read through those, make sure you understand what it is that you're signing and relate it to the certifications. So we can go ahead and skip to the next slide. We're going to talk about the guidance that the FDA or SBA has given us in regards to the required documents to submit. I broke that down into payroll, FTEs, and then the non-payroll costs. So for payroll, bank statements, payroll reports detailing the cash paid, the tax filings, and then receipts for the payroll costs like health insurance, retirement plans. So, canceled checks I've seen commented on, invoices or account statements just to verify that those items have been paid. The FTEs, you'll need some type of documentation to support that. And that could be in the form of the schedules that could be attached. And then the non-payroll costs, I've listed the most common items there: the mortgage interest, rent and leases, utilities, and just the type of items that you're looking for to retain in your file as you go throughout the 8-week cover period. So I really don't think any surprises here of much significance, but it just does affirm what we were thinking in terms of the back end and how it might look. So we're going to go ahead and move to the next slide. This is just a highlight of some of the items that are required to be retained but not submitted. So the Schedule A worksheet or its equivalents, the documents supporting the Schedule A Table 1 and 2, the job offers that are made for folks to come back and refuse, the firings for cause, etc. Keep your documentation handy for that if it's challenged. And then documentation around the FTE, safe harbor reductions and items like that. And let's see here. So I think at this point, I'm going to turn it over to Steve Snyder. He's going to get into the mechanics of the wage and salary reductions and also the FTE equivalent. So that was the overview, and he's going to walk down through some of the details of this calculation. So Steve, I'll hand it over to you.
Thanks, Chad. That was a really nice job you did on going through all that, and he calls that an overview because there's so much more to this than obviously what you maybe see in that couple pages of an application. But Chad went through the whole application, talked about some of the nuances, some of the questions we're going to have. My focus is going to be more on what's at the bottom of the application, which is where you're going to start talking about how is my forgiveness going to be reduced. And as he mentioned, we originally were under the impression it was going to start with the 75-25 rule, but they inverted that, and to the benefit, I believe. So the first part of that is going to be surrounding your wage salary reduction. And after you go through that, that's going to be the dollar for dollar reduction. Then you're going to look at your FTE count and how that's reduced as it compares to specific periods. And of course, when I get there, we'll talk through what those periods are. And then after you do all of that, then you're going to look at what is my eligible loan amount versus what is your reduced loan amount after you apply your wages and your reduction from FTEs. And then what is the 75% rule, 75-25 rule. And really there, all that's saying is that you can't spend more than 25% of your forgivable pool of money on other costs. So you take your total payroll cost, divide by 75%, and that gives you your total amount that's eligible for forgiveness. And then you just measure which one is the least amount, and then go from there. That's what you will be able to have forgiven. And then whatever's left over, of course, converts into a 2-year loan, payments starting after the 6th month at 1%. So I'll dive in here to the wage and salary reduction. One of the things that came out clarified on this was the difference between a salaried employee and an hourly employee, and having to look at them both a little bit differently. So once you determine what your covered period is, if you're going to use the period starting on the day you received your funds, or if you want to move that period, shift it to the first day of your next full pay period, of course there's benefits to either one. If you pay on a weekly or a bi-weekly basis, shifting that pay period or that covered period is really probably to your benefit. You won't have to mess around with determining your payroll costs or any additional payrolls you might want to run. Then there's those companies that are paying on a semi-monthly or a monthly basis, where you're going to have to use a little bit more of an analysis on there and what makes the most sense. In that case, it may make sense, depending on the dates, that you'll want to stick with your covered period, the original 8-week period. You may be able to get more payments into that period. But again, that's one of those areas that a lot of questions are surrounding. We aren't sure if there'll be more clarification coming out on that, so we'll stick to what the rules say at the time, and that covered period will be based on payments. So as you start to analyze your reduction, and this is part of Table 1 from your Schedule A worksheet, and that's where you're looking at your employees, and you need to list them out because each employee on its own is analyzed. So you got to list out your employees. You got to look at the salary employee, what their salary was during that 8-week period, and then you look at the hourly wage for the hourly employee for that 8-week period. And what you're really looking for is make sure they didn't earn over 100,000. But ultimately, as you work through these calculations, you're going to find that you need to know what your hourly wage is. Okay. So if it fluctuated, and I'm not including overtime in this scenario, I think the best way to approach it is standard time, although that hasn't been clarified either. So if you were to use overtime, that could really hurt you or help you, depending on how your 8-week period worked. But looking at your hourly employees at a standard rate, then you can calculate out what that average hourly rate is, and that's what you will use to work through the calculations. The calculation that you're going to use is going to be the same for all the measurable periods. I already said it's already on an individual basis. There is a safe harbor that is built into the wage and salary reduction calculation. This one wasn't mentioned in any of the previous rules that came out, the interim final rules or any of the FAQs, but they built in a safe harbor to avoid any reduction, if you've restored wages by June 30th of 2020. And then any reduction, of course, is a dollar reduction off of your forgivable amount. Kaylee, if you can advance that for me, please. So we're just going to run through an example. This will maybe help clear it up a little bit. So your covered period starts April 10th, runs till June 4th. You got an employee who has 2019 wages of $80,000, and in no period during 2019 did he have an annualized salary of more than $100,000. So what I'm saying here is, if there was a bonus in any one of those periods, that could potentially kick him out of being in Table 1, which Table 1 is where you're looking for a reduction in wages. Table 2 is for those employees that are earning over $100,000 at any point in time during 19 or that 8-week period. So Table 1 is for all your employees that earned under 100,000 on a pay period basis, okay, for 2019. So in this case, he earned $80,000. So his Q1 gross wages were $81,900. So he had a slight raise going into 2020. Not a big raise, but a slight raise. And then beginning on April 1st, all employees took a 30% pay cut. This dropped Bob down to $57,400 as of April 1st on an annualized basis. Company received their loan, and subsequently they bumped Bob's salary back up to $67,600 a year. He didn't get all the way up, but they did push him up to the $67,600. And I think I have it noted later that actually is greater than 75% of the $80,000. Okay, as you remember that this test, you are allowed a 25% reduction in salary to avoid a reduction. And we'll get into that in the later calculation. But I wanted to run this example to kind of show you that if you did reduce somebody's salary and then you push them back up over the 75, it didn't matter. You still would have to go through the safe harbor calculation. And then on the next slide, I start the calculation. So here is following the steps that are laid out in the application. So step one, you got to look at the individual and determine if they took more than a 25% pay cut during that period. So you look at your covered period. Bob earned $57,400 in that 8-week period. And you compare that to his first quarter of 2020, where he had that $81,900. So here you can see he took a reduction of 30%. So by default, you need to move on to step two. Had that been only 76%, then he would have been eligible, or he would not have had a reduction in his pay. But since he did go below that 25% down to 30, we have to move on to step two. And this is where we determine if there was a safe harbor that was met. Okay, and if you don't have to go to that third step of actually calculating out the actual reduction in your forgiveness. So here you got is, what was his salary on February 15th? So what you're doing is you're looking at the pay period that contained the 15th, and whatever his salary was for there, you would annualize that, and you'd come up to the $81,900. So then next, you would look at his average annual salary between February 15th and April 26th. And what was his average salary in that time period? Well, that was $73,143. And in this case, it's still not up to where it should have been on February 15th. Had they restated him back to the $81,900, then you would have been done with this step. Okay, and then you would have moved back to step three right away. But otherwise, you get to move on and look at, all right, my last chance here is June 30th. Did they put his salary back up to the $81,900? And they didn't. So they kept him at the $67,600, which was that slight increase, after they received the money. So they pushed him up to the $67,600, which did not qualify for the safe harbor. Because of that, going to move on to step three, where they're going to calculate out the reduction, which I have on the next slide there. So here, you're going to take the amount that was entered in that step 1B, right, which was the $81,900, the first quarter of the year, and multiply that times 75%. That's the threshold that they could have kept him at without a reduction in forgiveness. So the difference there, and then in line B here, is the $4,025. Okay, so $4,025. Then you have to divide that by 52, because the $4,025 is the annual difference. Divide by 52 times 8 gives you what your reduction was over the 8-week period. So that 619 gets dropped into table 1 for Bob, which then will be accumulated as you work down through that schedule and you do everybody else. So each individual employee has to be looked at like this. Now, if you have an hourly employee, it's done a little bit different. All the steps are the same, so you get to step 3. And in step 3, you're looking at the hourly average rate and looking at the rate reduction. So did their standard rate, we believe you'll look at a standard rate, if that dropped below 75%, and if so, then you'll have to calculate out what the rate drop was. What does that equate to over the hours worked during the covered period? Okay, you'll need to figure out what the average hours were worked a month, and then you'll work that up to be the calculation for an hourly person reduction. It's not exactly straightforward. There's a lot that goes into it, a lot of what ifs back and forth. But if you did reduce salaries by over 25% after that first quarter, you may have to work through these calculations. And then the next slide, we get to move on to the FTE reduction. So here, this one here is a lot of data gathering. You have a lot of different time periods you're looking at here for your comparisons. Just to give you a heads up, a warning, you'll need to gather some data by specific time periods. I'm going to work through a few of these, okay? So the calculation came out, or the application came out and kind of defined what the number of hours are that defines what an FTE is. We were thinking, we were under the impression that the rules were going to follow the most recent bill that was signed that talked about FTEs, which was the Affordable Care Act, and they used a 30-hour week to determine what an FTE was. But new administration, all that, so they are using 40 hours on the application. I've seen many questions come through where people say, our standard FTE, our standard full-time person is 37 and a half or 32 hours. How do we handle this? Can we just use those hours? My suggestion is no, you have to use 40. That's what's on the application. But understand that regardless of what you're using as a full-time person hour-wise, you have to apply those 40 hours to the measurable period, the comparative period as well. So somebody working 30 hours in the prior year versus during the covered period is the exact same FTE at 0.8 or 0.9. So there's no reduction because of that. Just remember your apples to apples. And Chad mentioned in his part of this that they actually offered you 2 options in determining what an FTE equivalent is. So, of course, anybody that works 40 or more is going to be 1. But anybody that works less than 40, you have to take their hours worked, divide by 40 to come up to what their FTE number is. And number 1 there, the example I use is 37 hours, gives you a 0.9. The other option you have is to look at anybody under 40 hours and give them a flat 0.5. Whether that's easy for you, whether that makes sense, that's up to you. Suggestion here is to look at it both ways to determine if one way or the other impacts you, could hurt you, could help you. If your business is under 40 hours, or your requirement is under 40 hours, it might make sense to go with the actual calculation, but you won't know unless you apply the half mark. So if you have a large workforce that works under 20 hours a week, it might be much simpler to just apply the 0.5, as long as there's not a lot of large fluctuations in that throughout the year. It also would make a lot of sense in that case to measure it both ways to see which one works best for you. So in the application, there's actually the spot before you start determining what your reduction is going to be. There's actually a spot in there that asks you if you have not reduced your number of employees or the average paid hours of your employees between January 1, 2020 to the end of the covered period. You don't have to go any further. You just check that box, and you don't have to go through these calculations. But I'm certain you will need to supply proof that that is the case. So if you can't check that box, you'll need to move on to the next slide. There we go. There's the one. All right. Before we get into the calculations, they did offer some clarity on some exceptions to calculating your FTEs. Any position for which the borrower made a good faith written offer to rehire an employee during the covered period or the alternative covered period, which was rejected, you can exclude them from your calculation if they decide not to come back. Or any employee who was fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours during the covered period. You can actually exclude them from your calculation. I think this could be helpful. I mean, these are questions that I've seen quite a bit, and I have heard of people not accepting the offer to come back, whether it's because unemployment is paying more than they were earning, or maybe they took another job, or they just need to stay home or decided to retire in some cases. So luckily, they gave us clarification on that, and for those individuals with the proper documentation, you can exclude them from your calculations. And the next slide, we'll step into the next part of this. So on Schedule A, it asks you for the following numbers. Okay, and like I said, there's a couple time periods where you'll have to go through and do some calculations. So your average FTE, you get to choose the between these two periods as to what you want to compare to your covered period, right? So your average weekly FTE between February 15th and June 30th of 19, or between January 1 and February 29 of 2020. So you can look at those two periods, calculate out your FTEs, and compare that to your average weekly in your covered period, okay? And if you don't have a reduction there, you're pretty much done. You know, no reduction, you're good. You don't have to worry about the safe harbor. And the safe harbor is what we'll talk about next, right? And your average FTEs for the covered period are going to come from Table 1 and Table 2 on your worksheet, okay? And remember that your tables do not include any owners. So owners are excluded from both of those tables. So then you'll take your number 2 answer divided by number 1, and you'll enter that on line 13. All right, that'll be your reduction quotient. Again, if it's no reduction, you'll be good. But let's go on to the next slide, and we'll talk about the safe harbor calculation for your FTEs, okay? So at the bottom of Schedule A, there's a section there with 5 steps to determine if you qualify for the safe harbor and do not have to take a reduction on your forgiveness. And that starts with the first period, your average FTEs between February 15th and April 26th of 2020, compared to what it was on February 15th. So you got to find the pay period that contained February 15th, and that pay period will be compared to Step 1 in this area. And if Step 2 at February 15th is greater than Step 1, you're going to move on down to the Step 4. If not, you just got to go back to Schedule A and fill out what your comparative periods were, your 2 options to your covered period, because you don't qualify for the safe harbor. So if Step 2 greater than Step 1, you can move down. Step 4 is taking the total FTE in the pay period that contains June 30th. So did you reinstate your FTEs in full by June 30th. Okay? If so, you've met the safe harbor. You can enter that 1.0 on line 13 of the application and have no reduction to your forgiveness as it relates to the FTE. So one of the questions circling all this is now the June 30th date's coming back into play. We were always curious as to how this would look. Your covered period ends way before June 30th, and then there's that pause. We thought you needed to get your application in as soon as that covered period was over, but based on the safe harbors here, it probably makes sense to wait. So you'll get to the end of your covered period. You still have some time to rehire your employees back, get up to full strength, to reduce your forgiveness, get their wages back up to full strength on June 30th, and then potentially have no forgiveness reduction at all, depending on your 75-25 rules. And then after that, then you can submit your application for forgiveness. You have a 6-month deferment period for your loan. So the rush to get this in isn't that great. You'll be submitting this with an idea as to where you stand. The lenders, of course, will be looking at everything you provide. They may come back to you. There's a 60-day window for you to hear what the results of the forgiveness are. So your lender can potentially come back and say, that doesn't qualify, you need to adjust, and then you'll have to resubmit. But you still will have a good 3 to 4 months from the time your covered period ends till when you got to make the first payment on the loan. So there should be time from June 30th until the loan payment comes due for you to reestablish your salaries and your full-time equivalents to minimize any reduction in your forgiveness. I hope that was clear and that you got something out of that. I'm sure, I think I've seen the Q&As really piling up. So we'll have a little bit to discuss in the Q&A section. But with that, the next thing that we have for you is sort of like a mini roundtable to talk about workforce and some of this stuff. And I think this is a really good leadway into to really pull Kristi and Chad up and ask Kristi what her thoughts are on the impact of this forgiveness application on the workforce.
Hi, everyone. Hope you're doing well. Thank you so much, Steve. Yeah, the PPP has definitely given us a few more dynamics to think about as it relates to workforce. And Chad, oh, good. I'm glad you joined me here. As we're talking to clients every day, there are concerns. Am I going to be able to bring my workforce back once the PPP funds run out? What do I do? How do I handle that? Do I now lay employees off again? And so just a real quick reminder about the difference between furlough and layoff. Furlough is if you're doing it temporarily with the thought of bringing them back in the next few weeks or so, or doing a rotating schedule just because you don't have the level of volume you did prior to COVID. You would keep your benefits intact and so forth and still treat them as though they're an employee. Layoff, on the other hand, is where you now are moving them out of the organization more permanently. You still could call them back, but you just don't know when or if that's going to happen. Pennsylvania last week reminded us that we have a form that we need to give to those who we would lay off, and it is the PA 1602. Did I say that right, Chad? 1609.
1609.
Yeah. So I know we have people who are participating from other states. So just make sure that if there's anything in your state that you're required to do as part of that separation process, that you follow closely by going to the state unemployment website to make sure you're compliant in that way. So Chad, is there anything else that you want to touch on from that perspective, from like laying people off and the coming to the end of the PPP?
Yeah, just a couple things. To add to that, there's some of the flexibility is nice. Again, if you're in a jurisdiction that maybe waiting to that next pay period is going to allow you to have a few more days where you're fully staffed in your calculation for forgiveness, that could certainly be advantageous. So you want to look at those alternate calculation dates. Also, I think just the flexibility of not having to do these off-cycle payrolls and things is very helpful. One of the other rumblings that we've heard in some of the acts and also is potentially expanding the 8-week period to a 16-week period. And again, this is very premature to make any decisions off of this, since it is just really rumors and discussions. But if you're not open, and in some cases we've heard the shutdown orders extended to August now. Again, do you keep your people out on unemployment and hope that you can extend and use these funds over 16 weeks? Again, even if you don't achieve full forgiveness, I can't stress enough, it becomes a pretty favorable loan, 1% interest, payable over 2 years, and it can really help shore up your working capital going forward. So even if you don't have full forgiveness, if you're closed till August, you may really need some of that working capital to get yourself back up and running in that period of time. So I think a lot of the same considerations apply, but just some other things that we're monitoring and maybe some flexibility that might help a little bit.
Yeah, and one last note on that PA form that I wanted to make is that it's only required if you separate employment with the employee voluntarily, but either you terminate them through a layoff process or they handled themselves inappropriately and you terminate their employment, so forth. If they say, hey, look, I'm not coming back to work, they normally disqualify themselves from unemployment. So you would not give that form because you're not trying to educate them on how they would apply for unemployment. So I just wanted to hit on that because I thought it was a really good question that came in to the Q&A area while the PPP discussion was happening.
If I could just hit on maybe one final planning consideration, not necessarily directly related to the workforce, but we've had some discussions about employers that maybe they're concerned about being near that 75% cutoff and want to try to maximize their forgiveness, and maybe want to be a little generous to their employees to thank them for the efforts during this time. Potentially putting foregoing withholding the employer contributions to health insurance. So if you think about that now, you're going to get their gross wages, and you're going to get the health insurance expense in full from the employer. So it's a nice way to show some appreciation to the employees, and also maybe get your forgiveness percentage up a little bit. That should becomes a pass-through for the most part. Now you would have to pay the FICA tax and a couple other things on that. So we're not necessarily advocating that in all situations, but just something to think about that we've heard discussed, and I think it does have some merit in certain circumstances.
All right. Well, thank you so much, Chad. I just have a few more comments, and then we are going to bring Rick into the discussion. So I noticed that the Department of Labor has added a few more questions to their list, to their FAQ. So my friendly reminder, if you haven't gone out there recently, I encourage you to do so. Question 90 is surrounding temp agencies and employees that may work for one. So if that applies to you, go out there. Number 91 is about teleworking. My employee was teleworking and doing a great job of balancing everything. Now they're saying they can't come back to the child care. How do I handle that? Number 92, I'm really surprised to see this, but it has to do with tiredness. So I'll let you have fun reading that one. And then the last one, number 93, this is definitely relevant because we touched on it last week. It's just about the whole summer vacation, summer camps, and so forth. So if you have, the question talks about a distance learning type of environment where your child may have been going to school online or participating through Zoom, etc. And now summer vacation happens for the school, and that's a normal part of their process. Does that qualify for the EFMLA? And the answer is no. It's not that they're closed because of COVID specifically. They normally would close over the summer. So you want to be very careful as you have employees who now have that dynamic of sending kids to summer school or being home for summer vacation. Does it truly fit the test of one of the COVID reasons? Because you want to be able to support that documentation and keep that on file in case you're ever challenged about the payroll tax credits that you have taken advantage of. So that's all I have for today as far as workforce regulatory updates. I'm going to invite Rick to come in here and talk a little bit about the future, which is more optimistic than the past, and then he'll take us from there. Rick, you're on mute.
All right, am I okay now?
You're good.
Okay, for some reason it didn't click. Thank you. But as I said, in some of our past town hall meetings, we had the panel discussion talking about encouraging people to design their roadmap to reentry, really talking about some of those key functional areas, and we referred to Daniel Burris's book, The Anticipatory Organization, asking you to think about those disruptors as you get into this reentry phase. Being an anticipatory organization requires you to constantly be scanning the horizon for those major disruptors in your business and your operations. And by doing so, allows you to identify them and pre-solve the issues even before they come to pass. In an effort to have the audience, think about these things, especially as businesses are starting to pre-open or come back to reentry, we focused on facilities. We've talked about workforce, technology, as well as just overall operations. But the exponential changes that we're seeing in technology represents a future fact, and that it can always be assessed by the certainty of things happening based on measurable, tangible, fully predictable facts. In our AO world, we like to refer to those as a hard trend. It's something that's just going to happen. It's going to happen at an increasingly higher pace, and you can approach these things with very high levels of certainty. One of the hard trends in technology that we're seeing is the emphasis on data analytics, which encompasses the technologies and the techniques to use to capture, utilize, and analyze massive amounts of data. What you need to do right now as you look in your technology area is to take a forward-looking view of your enterprise resource planning system, your ERP system. Doing that is critical at this time, particularly to ensure that the business intelligence that you're capturing is able to come across the different functional areas and enabling you to make, timely, smart decisions in your operations. Today, joining us with the panel is Susan Patrick, who is the Director of Client Solutions for Stambaugh Ness. And we're going to ask her just to share her insights and some opportunities you, from an anticipatory organization standpoint, should be looking at as you take a look at your ERP or your enterprise resource planning system. So with that, I'd like to ask Susan to click on her webcam and join us for just a quick overview and a little bit of Q&A. Thanks, Susan.
Great. So can you hear me okay? That was a thumbs up. Okay, awesome. So hopefully my component here will be a little bit lighter than the PPP forgiveness. That was pretty intense. But I'm kind of hopeful here that within the next 6 months or so, many firms will be back to full capacity. So that's exciting, and I hope that comes to fruition. But I want to challenge you at this time to kind of look at what steps you are taking now to really empower your team and take your firm to the next level regarding automation. We often think of 3 key areas in any organization: people, processes, and technology. As Rick said, whether you like it or not, technology is here to stay. It's one of those hard trends that's advancing faster than ever. And I get it. It's very hard to keep up sometimes. Very often, we talk to firms and find out that they're barely scratching the surface with their ERP system, whatever it happens to be. Often finding out that they're typically only using about 20, maybe 40% of the systems that they have. Many of them are using their systems today the same way that they were when they implemented and purchased their system many, many years ago. I've been working with clients for over 30 years implementing ERPs, and I know that the undertaking of moving to a new ERP is often very overwhelming for many. There are few of you that it's very exciting, but it can be very overwhelming. And what firms often do is they take their existing processes from their old system and just move that status quo into the new system. Maybe not changing anything, or maybe just adding a few new things to their day-to-day operations in the transition to the new system, but really then they stop there and they stop improving. So I want to fast forward you to today, and I want you to think about where you might know that you might have room for improvement, or think about areas of improvement. You know, if you're one of those firms that did not make significant improvements back when you implemented your current ERP, or you haven't done much since then, now's the time to sit back and take that inventory of what you're using. There are a couple things that I want you to kind of keep in mind in this process. Let's say first and foremost, you always want to stay on the latest version of your software, whether you're on premise or the cloud. Certainly the cloud has certain benefits and offerings. Today is not to talk about the cloud, it's just talk about taking your ERP to the next level. But make sure you're on the latest version of the software. Beyond obvious things like missing out on some new great features by staying on older versions, there are some cases that when you get behind on your ERP, it may actually cost your firm more in the long run with upgrades and, quite frankly, the possibility of lost productivity because you are so behind. So let's sit back and think about starting to take that inventory. The first step that you want to do is really evaluate your current usage of your system. Are you doing things today in Excel? Are you possibly still printing things on paper, printing out reports and passing them around? Granted, today, if you're working remotely, that became really difficult fast. Are you doing invoices manually where you could possibly automate that? So kind of start taking an inventory of your internal processes and what you're doing. You should also look at the people side, though. And on the people side, what you want to think about are your team members frustrated with how they're able to use your current system. For example, you know, we all kind of got forced into being remote. Were your people at that point unable to do their timesheets or their expense reports or access project information that they needed because they were remote? So maybe think about the fact that maybe there are mobile components within your ERP that you could actually implement to make it easier for your team to do their job. The other people component is, have you actually done kind of an analysis or, you know, walked around and said, hey, are you guys keeping your own records outside of the system? You know, some people do that because they can't get the information that they need right from the system. They don't know what to ask, or maybe they don't even know that it's there. A lot of the systems today have come a long way from a dashboarding perspective and the information that can be easily accessible to your team based on their role right there front and center. So if you're not using them, you're really doing a disservice to your team. And then the other piece of this is, don't overlook your overall business needs. Businesses change and grow over time for many reasons. So are you using your system now the way that you did originally when you were a 20-person firm, but now you've grown to maybe 50 people with 3 offices or maybe 50 remote offices? So think about how your business has changed. And again, to kind of Rick's point, try to be anticipatory. Where's your firm going in the future to make sure that you're taking those steps to kind of be in the forefront of that? Are you tracking the right data? You know, what data is there that could be available to your executives, accounting, marketing, sales, project managers, and so on? Are you tracking the information that they need? And not only is it the right data, but is it quality data? You know, is it time to start kind of doing an inventory of that information and saying, hey, what can we do now to clean up our data and get the information in so that when we do get back to full speed, you know, 3 months from now, 6 months from now, next week, that we're able to actually be more productive and empower our team members with the information and tools that they need to make informed decisions much faster. So if we kind of wrap this up a little bit and talk about some of the specifics, Again, think about mobile tools. Does your ERP have a mobile tool that's available and you guys just never deployed it? That would be a great step in the right direction. Take advantage of any electronic access or distributing of information electronically, dashboards, or delivering reports electronically instead of paper. And again, going paperless. You know, does your system have a document management feature that's fully integrated so that you can actually store those copies and receipts and stuff directly in the database for easy access anytime, anywhere for the people that need it? And then things like automating approvals. You know, before are gone, quite frankly, are the days where you would walk around the office and pass things around to get them approved, whether they're timesheets or bills to clients. So automate approvals. We've had a lot of clients within the last few weeks raise their hand and say, hey, can you help us implement some automated approvals and processes in our system so that we can be more efficient? I don't want you to think about it as a once and done thing, right? Improving your processes is important, and for you to periodically review these processes and look at how you use tools. You know, maybe it's something you revisit quarterly. Maybe you create a focus group in your organization. But take that inventory, prioritize it, make a plan, and execute. The technology is there, most likely in your system, and you are not taking advantage of it. So let's take advantage of it now and work with your team and your processes to get all that aligned to take advantage of it. I guarantee you that doing this will be worth it. It may be a little hard, but it will be worth it in the end. Technology is changing faster than ever. You know, Rick indicated that. It's on warp speed. Being anticipatory, I threw that in for you, Rick, is important, and just kind of look at your processes and procedures and your people and your technology and take that time now to kind of marry all those things together and take your firm to the next level. Don't be reactive, be proactive to get this done. So that's all I had for today, Rick.
No, but Susan, I do think that some people may still find themselves in a little bit of reactive mode because there were some gotchas that I was talking to some clients and saying, boy, I'm not getting paid on my AR, only to find out that the client, they're in a virtual situation right now, and they didn't have the ability to print checks, you know. So, yeah, there's some of these things that, to your point, anticipate those going forward, deal with those issues right now, but this is going to be an opportunity to really take a look at those people processes and really say, what's going to be best for us going forward? You know, really, you know, take the time right now to look at those things. You know, it's amazing. I was just reading an article about technology. Everybody's hearing about 5G. Hey, it's coming. Back when probably people don't even remember 3G. Well, when you went to 4G, that increased the speed and everything by 10 times. Well, 5G is going to do it 10 times more. And all these new things and applying ability to communicate is going to just get that much faster and that much more efficient. So we got to stay on top of these things. I think we want to ask Kristi to come back and join us. We have one other topic or so maybe on the round table, and then we do want to make sure we leave sufficient time for some of the Q&A, because I know, as Steve and or Chad said, that there's quite a few questions we want to make sure we get addressed. Kristi?
All right. Well, thank you so much. As we have the others join us here for the roundtable, Susan, you don't have to step away. We're going to go ahead and launch a poll question because we're interested to know, how comfortable are you with the loan forgiveness calculation? So, Kaylee, if you'll launch that, everybody can click one of the three, and once we get a good response, we'll go ahead and post those results so everybody can see how your peers are feeling about this. Looks like everybody is landing pretty much in the middle there. So, all right, Kaylee, do you want to post it? Great. So you should see those results. We have a lot of people who right in the middle there. I'm glad to see that we have people very comfortable. And for those that say help, it's okay. You're not alone. We're happy to help you because, as we've always said throughout this whole COVID situation, we're in it together. We're going to get through this together. We're going to look back and hopefully have some good stories and maybe a few laughs along the way. So Do I have Phil to join us here as well? I see Darren popping up. While we're waiting for Phil, I will just ask each of you to maybe respond. And Susan, you gave me something to think about here. As you said, take your ERP to the next level. Phil, I think we're getting feedback on your system. It gave me a thought about, as we think about our organizations, what else, as we have different experts here on the roundtable, what else comes to mind when you think about taking your organization to the next level? So for me, within the workforce vein, I'm thinking, okay, we've been forced to do remote work, telework, in many companies, 100%. So how are we going to embrace that? Not saying we have to adopt it 100% fully going forward, but what are we going to do to help leverage that with our recruiting and retention strategies? And also to Susan's point, how do we automate? How do we now stay paperless permanently? Because we weren't printing checks and we weren't doing a lot of things maybe we would have been doing if we were still in our offices. So Darren, I'm going to ask you from an operational perspective, what comes to mind as to what a company can do to take their organization to the next level?
Thanks, Kristi. I think the other thing that I picked up on that Susan said, and we hear a lot, is talking about people, processes, and technology. And so, I think over the weeks, especially with these panel discussions, we've kind of addressed all of those areas. Kristi, you've talked about the people side of things. Katie's talked about the people side of things. Susan just hit on, I'd say, processes and technology quite a bit. So what that kind of makes me think about is the fact that, this is the perfect time. And I'm hearing that out of necessity, maybe a little bit, that a lot of people are actually needing and starting to work on the company rather than in the company because they have to for survival purposes. And so that to me is, obviously the cornerstone for taking your business to the next level. And so I don't know if it's an operational standpoint, but from a financial or operational standpoint, I think one of the things people should be thinking about is their value proposition and understanding what their value drivers are with their customers. There's surely going to be opportunities that come out of this. And so to the extent that you can understand what value you're bringing to your customers and think a little bit, maybe think outside the box a little bit. Maybe there are some services that you could provide that complement a product and enhance the value proposition that you're putting in front of a customer. So that's one area that came to my mind.
Excellent. So Phil, I'm going to pass it over to you. What comes to mind for you? And then I'll also allow you maybe to react to some of the things that Susan was talking about, since your space is technology too. You're on mute.
How about now? I want to make sure I don't have the feedback. Good?
Yeah, thank you. You're good. Yeah.
All right. So, I think everybody's touching on it here, the culture side of this, and Rick even had made mention about the 5G piece of this here as we roll in technology and how it's best used, and the organizations that are, moving to more of a scalable, maybe not even scalable is the word, but more of a fluid infrastructure. My comment to the 5G and just how people are utilizing remote applications. When organizations are looking at how to best use those, you're going to have to evaluate bandwidth, be number one, the amount of devices that are streaming. I know I was on several calls the other day, and, things would just constantly stop. They're glitchy. I'll call them glitchy. That's the word that everybody knows. And it really just comes down to when you start streaming data across the network, it's really imperative that you evaluate, the resources you have, your internet service provider. And I know I stressed this before, And even Rick there, again made the comment on the 5G piece of it. It's up and coming, and this whole COVID-19 ordeal has just amplified it. So your organization needs to be evaluating the new technologies that are out there. Just like Susan had mentioned, my goodness, you probably have an ERP system that you're utilizing and haven't even touched a portion of it. The capabilities there, please reach out to those individuals that you partner with and start doing a deeper dive at how those applications can assist your infrastructure or your organization going forward. Like Darren had mentioned, focusing more on the business.
All right. Thank you, Phil. So, Rick, what comes to mind for you as far as taking the organization to the next level?
I just think that I'd like to hope that people are taking to heart our conversation of incorporating some time in their daily routines, weekly routines to look forward to this. Because as I listen to different panel discussions, firms across the United States, this whole remote, I actually heard a little bit of change in the tide where people were saying we're going to just go completely remote. I'm hearing conversations about people still like the interaction and the culture and that type of thing. So I think we've got to really look at, eventually we're going to come back together. It's going to be different. It's going to be in waves. And I do think that with that, we need to still look forward to, should this, it's not going to be if, but this is going to probably happen again, something of similar. So we need to have those plans and to be able to really have the remote and virtual so that it is the flip of a switch. And all these things that Susan referred to and I referred to. And that's why I mentioned about the 5G. I don't think we're going to go back to 4G. I don't think we're going to go back to 3G. I think as sure as we're all on this panel, there's going to be a 6G. I don't know what that's going to look like, but just with the technology, leveraging that, like Phil said, and to take advantage of it. I think we've talked about some of these previous sessions where we've had interruptions. Well, this technology is starting to address those with some of the bandwidths and all. So this is the world we're going to be living in, and we want to just make sure that we're posturing ourselves to be really capable and able to execute at an efficient level.
Yeah, and at the core of the discussion throughout COVID is change, right? And managing that. You're going to have people that resist it. You're going to have some steady eddies that try to use it. And then you're going to have others who really are excited about it on the bleeding edge and really can embrace it. So, Susan, in working with clients and so forth, do you have any tips or tricks or any words of caution as people might now be scratching their heads saying, you know what, we do really need to look closer at our technology, maybe make some changes, decisions? Do you have anything that you would want to share when you're thinking about the dynamics that people might bring to it, resisting, embracing, or somewhere in the middle?
Yeah, absolutely. Thanks, Kristi. I think when you talk about getting a firm on board with the change, right, that's the hardest part, the change. And this whole situation we're in is kind of forcing our hand with that. I would say that when you take that inventory and you kind of look at where you can improve your company, engage your team members so that you can determine where you're going to get the biggest improvement, where you're going to have, the deepest spread across the organization. And it might be something as simple as being able to do timesheets remotely where you couldn't before. So, working with your team, and don't hesitate to pull other people in where you may not normally. A lot of people using ERPs typically kind of hold that close to their heart from an accounting perspective and really don't leash that out to other people in the organization. Now's the time to kind of look at it holistically and say, where can we help across the board to utilize the system better and take our system to the next level?
Thank you, Susan. So in a way, technology and the ability to respond to our clients or customer needs or to get a product to market more quickly gives us the ability to sustain or establish a competitive advantage. So Darren, I'm going to shift it over to you. What else should companies focus on now that more and more are starting to open, get back to business, to really keep or get the competitive advantage?
I'm sorry, that question was for me, correct? Sorry, I had a notification and I couldn't hear your whole question, but I did hear most of it. So yeah, I think there are a number of things that I think can be impactful to profitability of companies. But from a financial standpoint, I read a statistic recently that 1% improvement in pricing results in a 10% increase in your profitability. And so anticipating that companies will probably be focused as more and more begin to reopen and the economy starts to move forward, I think most companies are going to be focused on two things. One is retaining customers and projects, and the other is acquiring customers and projects. And so I think now's a good time to look at reviewing and evaluating your quoting and pricing strategy. There are a lot of different strategies out there, but I'm not sure that many people really look at it as a potential strategic advantage over their competition. You know, a lot of them are formula driven. So it's either maybe a cost plus pricing, cost multiple, or volume based where there's discounts and rebates. And so a lot of times that cost-based pricing is sometimes offset or balanced out with competitive market pressures, but rarely do we see value pricing. And that ultimately accounts for the perceived value of the customer by the customer. So I think one of the areas that I would encourage companies to take a look at as we start to get back into a recovering economy is to look at their quoting and pricing practices.
All right, thank you. Does anybody have anything else that you would like to share with the group today who's on the round table? Because we're narrowing down on the last 15 minutes. Tom has a few words, and then we want to shift to Q&A. But if we want to take a moment or two, if any of you have anything else additional? No? Okay. Well, thank you so much for participating. I greatly appreciate your wisdom and insight that you shared today. I'm going to ask Tom to come up and talk to us a little bit about R&D and how that can be used to take your organization to the next level. So Tom, take it away.
Thanks, Kristi, and thanks everybody for your comments. And I just wanted to kind of ramp off of everyone's comments in the roundtable. Everyone's talking about utilizing technology to its maximum, taking us to the next level. And certainly that takes a little bit of investment on everyone's part. And in these uncertain times, everyone obviously is thinking about how do I pay for that. So that's why every week I just like to remind people a little bit, don't overlook this powerful tool, the R&D tax credit. It's not going to apply to every single company out there, but it certainly applies to a lot more than probably give credit to. And we've generated a lot of discussion through these town halls the last couple of weeks, and have been fortunate enough to kind of educate some folks on how they might use this and help pay for things. So on the kind of theme of technology the roundtable had today, I just wanted to share a couple of things that are maybe kind of directed towards the manufacturing industry. We've talked about some of the software enhancements. We've talked about some of the things the AE world can do in prior weeks. But so Kelly, if you could advance the slide there. I got to give credit where credit's due. And first of all, I'll give credit to Darren because he's the one that saw this article and passed it on to me. But if you have a chance, no matter what industry you're in, I would urge you to go to Forbes' website and read this article by Anna Katrina Shedletsky. It was dated May the 12th, about a week ago. And it was really a great point that things are going to move so quickly now to adapt to what the new normal is, the things we must do to get our businesses back and thriving. The title of the article was Manufacturing Will Experience 5 Years of Innovations in the Next 18 Months. Certainly, necessity does drive innovation. When we're faced with challenges, we typically rise up and meet them. And well, it was a really good article with some really good ideas of things to implement within your businesses. Of course, my mind's thinking about, wow, all of these things kind of scream R&D as well, and you can get some payback for that. So on our next slide, just a couple of examples that I pulled from the article. So Kelly, if you would move to the next slide, please. One of the things it talked about is, and I don't want to stereotype manufacturers, but as a group, they've tended to keep their systems on premise and have been a little bit more reluctant to move to the cloud, whether that is because of security concerns or whatever their reasons were. But with now us forcing a lot of our folks, maybe our office folks, maybe our management folks, into remote locations, maybe we have multiple business units, we really do think there is going to be a trend to advance into cloud-based systems. Moving away from on-premise, it can reduce some of the travel time of visiting location by location. It really is going to unleash data that can be shared to identify defects, efficiency, identify things and address them remotely. So as you're thinking about those kind of changes as you move to the cloud, think about that may be another opportunity for you to look at the research and development tax credit. Certainly automation is going to take over. The article goes into great detail about electronics manufacturers, where many times these are folks that are sitting very close to each other doing very tedious work, and they're doing it because the technology changes so fast. They really maybe have rejected automating those processes in the past. Well, again, our new social distancing requirements may change that thought process. We may want to do a little bit more upfront investing for greater long-term efficiency, things that will take us well beyond COVID-19, things that will bring us efficiencies down the road. So as just a reminder, if we could go to the next slide, what does it take to qualify for the research and development tax credit? The activity really just needs to meet something called a 4-part test. And we certainly don't have time today to go into this in great detail, but to just give you that overview. And remember, it's an activity. It can be a process, a technique. It can be a new product, but it doesn't necessarily need to be a new product. Number one, the activity needs to be technological in nature. Well, I think everything we're talking about here certainly qualifies under that one. That's going to be an easy one, I think, to accomplish. Number two and number three, there's a process of experimentation to eliminate an uncertainty. Well, we're going to have to try new things. We will have to try alternatives. Some of them will work, some of them won't. We don't really know if it's going to work going into it. That's really what the credit is all about. You taking a risk, you being innovative to make your company better. And it doesn't matter if your competitor's already doing something separate or similar. You still need to go through that process yourself to take yourself to the next limit, or the next level. And lastly, the permitted purpose, again, really means you're just doing something new or improved. So as you make these changes, maybe forced, as it said, necessity driving innovation, think about how you may qualify. We're happy to talk to you about that. It may or may not qualify, but don't overlook it. It's a chance to get some significant tax savings, some cash flow in your own pocket to help you move to that next level. So again, as I said, more than happy to talk to you at any time about that. So those were just my words on R&D this week. I know we're down to only about 5 minutes left in today's session, but Kaylee, if we can, maybe we can get a question or two in for the folks here. I do know that Steve and Chad have been working frantically to answer the PPP questions. They are many, but Steve, Chad, Kristi, if you want to come back up, and Kaylee, if you want to give us a few questions.
Sure, Tom, thank you. So we have a large amount of questions in here, so I'm going to focus on some questions relating to the forgiveness application here. So Chad and Steve are going to be directed at you. The first question is, who needs to go on tables 1 and 2? I assume that anybody who worked during the covered period would be listed, even if they left employment before the end of the period or came on board after the covered period started. Is that correct?
So table, yep, I'm off mute. Table 1 is specific for employees that worked at any point during the covered period. Again, covered period being that 8 weeks from the time you get the funds, or if you select the alternative method, it starts on the first day of your first complete payroll period after you receive the funds. So table 1 is any employee during the covered period that has a place of residence in the U.S., of course, can't forget about that rule, and earned $100,000 or less as an annualized salary. If it's over 100,000, they fall down into table 2 with the same qualification rules. Hope that answers.
Alrighty, thank you. And the second one being, in calculating if a person's hourly wage went down, can I use the straight time pay rate average for the covered period compared to the straight time pay rate average for the first quarter?
So that has to deal with time and a half, and how that all comes into play. I'm trying to calculate out during the period, and that's a tough one because Chad, unless you know different, I didn't see anything that addresses how to treat overtime at time and a half, or even double, or shift differentials, or anything. So
yeah,
my thought
I
is,
don't.
You didn't see anything.
Sorry, go ahead.
No, I was just going to say, and this is my opinion, without having any other further supporting information, unless Chad knows of something, but I think you need to stick with straight time, because that's the core of that hour worked, and at least then you're apples to apples to your period. Because if somebody works overtime during a covered period but took a 50% pay cut, well, I think you should be penalized for that, even though they did get time and a half for that overtime. I think it's got to be at the straight time. I think that would make the most sense. Chad, did you hear anything on that, or?
I haven't heard anything definitive. The only thing I could think of is, I know the concept of regular rate of pay enters into some of the equations. I don't know if they're going to push us to those kind of a standards in regards to that. But I think based on what we're seeing, I think I agree with where you're at, is just use the base rate, because now all of a sudden you're adding multiple wrinkles into this. But we may need to go there. This is not clear yet.
Yeah.
Alrighty, and I think we have time for one more. It says, in calculating the average annual salary for salaried employees, do I just use a salary or all cash compensation?
So the definition of what goes on table 1 in defining is gross wages. So it's going to be essentially what comes off your payroll report. It's your gross wages when determining how to determine what your annualized salary is. There's no changes to that.
Alrighty, thank you, Tom and Chad. And thank you to all of our presenters that are up here today. We do have a large majority of Q&A to be answered here this afternoon, and we will make sure that these are pushed out to you via email once our presenters get the opportunity to go through and answer them. So, Tom, do you want to close us down here?
Sure. Thank you, everyone. Steve and Chad, some really heavy lifting this week. I think Kristi and I maybe had a little bit easier this week, but big changes there, and I know everyone's really interested in those. So I would encourage you all to join us again next week. I'm sure we will have more. We may even get some interpretations on the forgiveness as well. We do want to emphasize, though, again, that we are here to help. There's a number of ways we can help you during the week. If that's just answering your emails or your questions, please reach out to us. I know everything is centered around the Paycheck Protection Program right now. So if we can help you with those forgiveness calculations, I know some of you still may have some concerns on documenting your eligibility. The good news, as Chad shared last week, is if your loan was less than $2 million, you won't be challenged on that. But if you are over that, it still remains very, very important to document your economic uncertainty for taking the loan. So we can certainly help with that. We also, in other areas, we can certainly look at your workforce items, the unemployment and such, as well as everything that Phil's team does, Susan's team does, centered around technology. Susan gave us a lot of great insight today on maximizing your ERP systems. If you have questions with that, if you need help with that, we can certainly do that as well. I think I got my slides out of order there. I think we already talked about workforce. Certainly the 941 filings are coming up, and I know as soon as that comes out, there'll probably be a great number of questions on that as well. And certainly in my arena, as the PPP forgiveness deductions, if they remain non-deductible, they change to deductible, you're going to be wanting modeling out your taxable income situation for the year. Make sure you don't get caught with a surprise there. And we can also utilize a lot of these other provisions that have come out to minimize your taxes. And we'll certainly be keeping our eye on the HEROES Act and anything else that comes down the line that could change that. So Kaylee always says it when we start our sessions each week. It's a very fluid situation, and that couldn't be a better description of that. We'll be back again next week, May 26th at 2 o'clock Eastern. As a reminder, Valentina Madura from BDO Capital Advisors will be with us, and I think you'll find her comments very interesting as she centers around, what is happening with the value of each and every one of our companies. So with that, we'll sign off for this week, and we'll hope to see you all again next week. Thank you.